As with any interest rate policy decision from the RBA, there are two factors we need to consider. The first is the actual rate move itself, and then secondly, there's the statement that comes with that rate cut or hike in this case. So yesterday we had the RBA increase interest rates by 0.25%, taking the cash rate to 3.35%, which is one of the most aggressive rate hike cycles on record. Secondly was the statement itself, and this gives us a reflection or an idea of what the RBA is focusing on and what are the concerns they have in setting interest rate policy. At the moment, as of yesterday, that stance, if you will, is very, very hawkish in general, i.e. they are predicting more rate hikes because they are still worried about inflation, and as an extension of that or a leader to that, wage growth on the back of inflation already. As I mentioned a moment ago, this rate hike cycle has been one of the more aggressive on history. In fact, it's the most aggressive through history. We've seen rates increase 335 basis points since April last year, which is in less than a year, it's a substantial increase, going from 0.1% to 3.35%. If you look at the previous rate hike cycle, that kicked off in October 2009 on the post-GFC stimulus coming from monetary policy and to some degree fiscal policy stimulus. That rate hike cycle was designed to not to deal with inflation, but rather to bring policy settings back to a neutral stance, given the accommodation was no longer required as the economy got back on its own 2 feet after the GFC. This cycle, on the other hand, is more about containing inflation, bringing back aggregate demand in order to try and contain inflation, which is running just south of 8%, which is levels we haven't seen since the 1980s. So where to from here? The RBA, as I mentioned earlier, is still concerned about wage inflation and what that means for overall inflation. A lot of the inflationary pulses coming through should theoretically be coming off, i.e. that relating to flood issues, so higher food prices, supply chain blockages are being cleared up as COVID pandemic sort of subsides. And of course, the price of oil has come down since the Russian invasion of Ukraine. So their concern now is more about wage inflation or a wage price spiral going forward. This is what we saw in the 1980s. And in that scenario, price inflation or inflation in general becomes a self-fulfilling prophecy. Wages go up to counter price inflation, prices go up to counter wage inflation, so on and so forth. So the concern now going forward is how do we contain that? And that, based on their statement, is at least 2 more rate hikes, probably up to 3.85% at the bottom end, and possibly higher again up to 4.1%, which would be the most bearish or most aggressive rate hike cycle again through history. So at the moment, at least 2 more rate hikes. On the outside, 3 more, and on the extreme case, 4 more, up to 4.1%. So some of the real world impacts of the rate hike cycle are well known. Household mortgages go up, which reduces income and then in turn reduces household demand for consumable goods and the like, in turn slowing growth. Where this rate hike cycle differs from previous cycles has been the percentage of mortgages that are fixed at a low rate. In the past, we've had about 20% of mortgages fixed going into a rate cycle. This time around, because we had such low interest rates through 2021 and some of 2022, mortgage rates have been fixed a lot lower for longer. So we're looking at 30 to 40% of mortgages that are still fixed at low rates. So the increase in interest rates yet has not impacted household budgets, but it will happen later this year as a lot of those mortgages roll off and households have to move from mortgages of say 2.5% to 4.5%, 5%. A substantial hit to their budget, and this is in turn will slow growth down quite considerably going forward. Some of the benefits of higher interest rates are mainly felt by retirees who have a sort of fixed income source. Interest rates are going up, so the deposit rates are rising as well. Mutual, we have a large range of floating rate funds, so these funds benefit when rates rise because the interest rate or the coupon on each of these securities increases each time the rate goes up. So we're seeing a lot of interest in our term deposit fund, which has doubled in size in the last few months as conservative investors are putting their money aside in a safe interest rate immune product, which is providing good growth for that fund, and we're getting a lot of interest in that as well. For investors with a little bit more risk appetite, our higher rated funds or higher risk funds carry very little interest rate risk. Again, the coupons on these funds reset every 30 to 90 days. So every time the RBA increases interest rates, the coupon on these funds increases accordingly. So a good safe bet in a rising interest rate environment is to look at floating rate notes.